It's Thursday, December 8th. Before we get started, I'd like to thank all of our clients who came to our client appreciation on Sunday, which we had a tremendous turnout at a wonderful venue, Legacy Stables. Can't say enough good things about it. I'll tell you this, it'll be a place we'll probably revisit in the future. But thank you all for coming out. It was a very enjoyable event.
It illustrates that folks really want to get out.
We usually have somewhere in the neighborhood of 80 to 100 for our client appreciations. We had 160 signed up for it. So, people were wanting to get out, which sort of nice little segue into people really wanted to get out on Black Friday and Cyber Monday, and those surprisingly good numbers from where we sit.
In the radio show that we just completed, you talked about having a rally in a bear market, and that's probably where we are at this point in time.
Since October 1st, we've seen a nice rally. The last 7 days, not so much.
Right.
But I think we're going to see these ebbs and flows. I think we're going to see a trading range on the S&P 500 of, somewhere 10 to 15% up or down, back and forth, because we're starting to see the headwinds come towards us for sure.
Next week, the Federal Reserve, or the 13th or the 14th, the Federal Reserve will have the meeting, and they'll have their announcement of the next rate increase. It's expected to be 50 basis points. We don't have a reason to believe it would be higher.
No.
Don't have any reason to believe it's going to be lower. The question is how long and how far into 2023 will it carry us? The terminal rate that we have been talking about for 6 months, that rate in which the Fed can say it's enough and inflation rolls over, still is being targeted 5 to 7%. Let's split it and we'll call it to get 6. We're right at 3.8, right under 4. So we got a point to 2 points that we need to go. So there is still going to be tightening, and we're beginning to see indications of slowing in the economy.
And layoffs. Starting to see those things. I think you'll see even more after Christmas. It's a struggle going on in the labor market right now, where we're seeing a good job growth, and the Fed wants to see just the opposite. You never want to have a Fed rooting against the job creation, but that's really where they are right now.
Right. This balance that we have your equity weighting in somewhere between, on average, everybody's different, somewhere between 40% and 50% seems to be the comfort zone that is giving opportunities. When the market's up, we're gaining some value, but when the market's down, because of what we've bought into, equities that pay dividends, we aren't participating in the full downturn, and we are still capturing strong returns in the Treasury, individual Treasuries, in a group yesterday, and we stressed to them that we're building 3 months, 6 months, and maybe if we could get a good, solid, bigger return on 1 year, we'd be buying that. But right now, the sweet spot is in that 3 to 6 month window.
Yep, and we'll continue to see those roll over as they mature, and we'll most likely, given the conditions of today, do the same thing. And because it's 4 to 4.5% is a lot better than what you're going to be able to get in most investments right now.
17 days to Christmas. We hope it's beginning to shape up as a good holiday for you and your family. For those, our Jewish friends and clients, happy Hanukkah and what's coming up in that celebration for y'all. So it's steady as we go. We know exactly, we have a list in all our piles, and on the back of the list is what we want to buy. So we know what we want to buy. We're just going to be patient and let it come to us. But as we do that, we know it is your money.
And your money matters.
Be safe. Have fun. Happy holidays. See you next week.